There is a question that has followed Warren Buffett for more than half a century. It's whispered in boardrooms, shouted on trading floors, and typed into search bars by millions of aspiring investors. The question is simple. What's the secret? What is the confidential memo, the back-channel phone call, the piece of privileged information that allows one man from Omaha, Nebraska, to so consistently outperform the titans of Wall Street? People imagine a clandestine world of insider tips, of secrets passed between the financial elite. They believe that wealth on that scale must be born from an information advantage that is inaccessible to the common person, and in a way, they are right. Buffett does have a powerful, almost unfair information advantage. But it is not the advantage they think it is. The secret is that there are no secrets. The advantage isn't found in what is hidden, but in what is plainly visible, yet universally ignored. His edge comes from a simple, almost ascetic practice: the relentless, methodical consumption of dry, boring public information that everyone else finds too tedious to read. His competitive advantage is diligence. While the rest of the world is chasing fleeting headlines, reacting to the dramatic pronouncements of television pundits, and trading on rumor, Buffett is in his office, alone, for hours a day, simply reading. He's not reading secret reports. He's reading the same annual reports, the same 10K filings, the same trade journals that are available to you, to me, to anyone with an internet connection. The information is not hidden. It is simply buried. It is buried in footnotes, obscured by legal jargon, and spread across hundreds of pages of dense, black and white text. And because it requires effort to unearth, 99% of people will never even pick up a shovel. This is the great paradox of the information age. We have more access to raw data than any generation in human history. Yet we are more reliant than ever on the filtered, biased, second-hand interpretations of others. We let analysts tell us what a company is worth. We let news anchors tell us what an earnings report means. We have outsourced our thinking. Buffett has built a $100 billion fortune on one foundational principle: the person who does their own thinking, based on their own reading of the primary source material, will always have an edge over the person who doesn't. This is not a guide to finding a hot stock tip. It is a guide to rewiring your brain. It is about abandoning the search for secrets and embracing the power of deep, unglamorous work. It is about learning to see what everyone else sees, but to understand what they don't. Today, we deconstruct this method. We will not just talk about it. We will install it as a new operating system for your mind. We will move through 5 distinct phases, from the core philosophy to the practical application, until the act of reading a 10K filing feels as natural and as necessary as breathing. This is the real secret, and by the end of our time together, it will be yours. Our journey begins with the foundational law of this entire system, the principle upon which all of Buffett's investment analysis is built: the absolute supremacy of the primary source. This is the non-negotiable belief that the unfiltered, raw, and often tedious documents produced by a company or an industry are infinitely more valuable than any interpretation, any summary, or any news report about them. To truly understand this, we must travel back to 1963. The world of finance was in a state of blind panic over a company that was, at the time, a titan of American business. A blue-chip stock held in the portfolios of widows and orphans, American Express. The company was a symbol of trust and stability, its travelers' checks as good as gold. But a storm was brewing in a most unexpected place: Bayonne, New Jersey. A small, seemingly insignificant subsidiary of American Express, a warehousing division, had made enormous loans to a company called Allied Crude Vegetable Oil Refining Corporation, run by a charismatic swindler named Tino DeAngelis. The loans were secured by what was supposed to be a colossal amount of salad oil, stored in massive tanks. But Tino DeAngelis was a con man of historic proportions. He had discovered that by adding water to the top of the tanks, the heavier oil would be pushed up for inspection, fooling the auditors. Most of the tanks were filled with worthless seawater. When the fraud was uncovered, Allied crude collapsed overnight, defaulting on over $175 million in loans, a staggering sum at the time. American Express, which had guaranteed the receipts for the non-existent oil, was on the hook. Wall Street panicked. The headlines screamed of ruin. Analyst reports, the supposedly sophisticated products of expert financial research, were unanimous. American Express was facing catastrophic liabilities that could wipe out its entire net worth. The stock plummeted, falling by nearly 50% in a matter of weeks. The narrative was set, the story was written, and the herd was stampeding for the exits. This was the ultimate test of an investor. Do you trust the thunderous roar of the crowd, the seemingly impeccable logic of the experts, the terrifying headlines, or do you ignore it all and go to the source? A young Warren Buffett, then in his early 30s and running his small investment partnership in Omaha, saw the panic not as a threat, but as an opportunity. He refused to accept the second-hand story. He started his own due diligence. He began by reading the American Express annual report, the primary source. He saw a fundamentally strong business. The Traveler's Check franchise was a cash-generating machine, and the credit card business was a burgeoning giant. The numbers told him the core company was sound, but the salad oil liability was the great unknown. So he went to the next layer of primary sources. He didn't call another analyst. He started behaving like an investigative journalist. He went to restaurants and merchants who used American Express. He'd sit at a bar and ask the owner, "When the salad oil news broke, did you think about stopping your contract with American Express?" He'd talk to bankers, asking them if they were still recommending and selling the company's traveler's checks with the same confidence. He even visited American Express's competitors to gauge their perception of the company's predicament. Everywhere he went, the story was the same. The scandal was a Wall Street story, a headline story. It had not dented the public's trust in the brand. People were still using the cards. Travelers were still buying the checks. The company's core operations, its actual relationship with its millions of customers, were completely unaffected by the fraud committed by a small subsidiary. The panic was contained entirely within the financial echo chamber. While Wall Street was staring at the potential liability on the balance sheet, Buffett was studying the real-world asset that appeared nowhere on it, the psychological moat of trust in the minds of millions of consumers. Armed with this primary source information, gathered through his own legwork, he made his move. He invested 40% of his partnership's assets into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company settled the salad oil claims for a fraction of what Wall Street feared and the strength of its core business became undeniable, the stock soared. The investment returned multiples for his partners and became a foundational legend in his career. It was a masterclass in the value of primary source supremacy, a lesson forged in the crucible of market panic. The reason this strategy is so powerful and so rare is because it requires overriding a deeply ingrained human flaw in our mental software, the authority bias, coupled with its close cousin, the narrative fallacy. Authority bias is our tendency to attribute greater accuracy and weight to the opinion of an authority figure. In finance, the authorities are the well-dressed analysts on television, the authors of 100-page reports from prestigious investment banks, and the screaming headlines from established financial publications. Their confidence is infectious, their credentials impeccable. Our brain, seeking efficiency, takes a shortcut. It says, "This person is an expert. They've done the financial research. It's safer to trust them than to do the hard work myself." We defer our judgment, outsourcing our critical thinking to a perceived authority. Compounding this is the narrative fallacy, a concept popularized by Nassim Nicholas Taleb. Our minds are not built to understand raw data. They are built to understand stories. We crave simple, coherent narratives with clear causes and effects. The story of the salad oil scandal was perfect. Greedy company makes bad loans, faces ruin. It's simple, dramatic, and easy to remember. The truth, Buried in the annual report and discovered through painstaking on-the-ground research, was far more complex and nuanced. A diversified financial services company with an immensely powerful consumer brand experienced a manageable loss in an isolated, non-core warehousing subsidiary. This story doesn't make for a good headline. It's boring. So the market and the media that serves it defaults to the simpler, more dramatic, and ultimately incorrect narrative. Buffett's genius was in recognizing that the entire financial media and analysis industry is, in large part, a storytelling machine. It creates narratives to explain the random fluctuations of the market. An investor who consumes these secondhand stories is always going to be a step behind, reacting to a simplified, often distorted version of reality. The primary source investor, by contrast, bypasses the storytellers. They go directly to the source code of the business, the financial statements, the customer behavior, the supplier relationships. They are not consuming a story, they are constructing a reality-based mosaic of facts. This is mentally taxing. It requires holding complex and sometimes contradictory information in your head, but it is the only way to escape the gravitational pull of the market's seductive and often false narratives. So how do we, as individuals seeking financial freedom, put this into practice? We create a system, a mental model I call the Source Purity Protocol. It's a 3-step process for every single piece of investment information that comes your way. Step 1 is interrogate the messenger. The moment you hear a piece of information, a stock tip from a friend, a bold prediction on a financial news show, a recommendation in an online article, your first instinct must be to stop and interrogate the source. Do not ask, "Is this information true?" Ask, "Why is this person telling me this, right now, in this way? What is their incentive?" An analyst at a large bank may have an incentive to generate trading commissions. A television pundit has an incentive to be dramatic and confident to attract viewers. A journalist has an incentive to create a compelling headline to generate clicks. None of these incentives are necessarily aligned with your goal, which is to make a sound, long-term investment. Recognizing the potential for bias is the first line of defense. Step 2 is trace the chain. Every piece of secondhand information has an origin. Your job is to become a detective and trace it back. If an analyst report says, "The company is facing declining margins," don't just accept it. Find the company's latest quarterly report, the 10Q, and go to the income statement. Look at the gross margin line. Compare it to the previous quarter and the same quarter last year. Is it actually declining? Then go to the management's discussion and analysis section. How is management explaining this change? Are they blaming raw material costs, a change in product mix, a new competitor? You must follow the information breadcrumbs. Back to the primary source document. This single habit, if practiced consistently, will place you in the top tier of retail investors. You will stop reacting to opinions and start forming conclusions based on facts. Step 3 is generate your own primary data. This is the advanced move, the Buffett in 1963 move. For companies that operate in the real world, especially consumer-facing ones, you have the ability to generate your own primary source information. Are you considering investing in a retail chain? Go to their stores. Are they clean? Are the employees helpful? Are there customers? Talk to them. Why are they shopping there? Are you analyzing a software company? If possible, try their product. Read reviews on user forums. What are the most common complaints? What do the power users love? This is Scuttlebutt, the on-the-ground intelligence that Philip Fisher wrote about, and Buffett perfected. It transforms you from a passive reader of reports into an active investigator of businesses. This protocol, interrogate, trace, and generate, is a mental filter. It systematically purges your decision-making process of second-hand noise and replaces it with the high-fidelity signal of primary source truth. The antithesis to this disciplined approach is what we can call the path of the 99%. Embodied by the headline investor. This individual's investment research process begins and ends with their newsfeed. Their portfolio is a chaotic reflection of the last 72 hours of financial media coverage. When a tech company announces a revolutionary new product, the headline investor reads the glowing article, sees the stock price jumping in pre-market trading, and buys in, terrified of missing out. They don't read the company's 10K to see if this new product is even mentioned as part of the core strategy, or if the company has a history of overpromising and under-delivering. They are buying the story, not the business. A few months later, when a prominent analyst downgrades the stock due to supply chain concerns, the headline investor sees the red arrow on their screen, feels the pit in their stomach, and sells at a loss. They don't have the conviction that comes from independent research. Their confidence was borrowed from the initial headline, and it vanishes with the new one. This investor lives in a constant state of emotional whiplash, jerked around by the narratives of the day. They are perpetually buying high on excitement and selling low on fear. They mistake the stock ticker for the business. They believe that if the price is going down, the business must be failing, and if the price is going up, the business must be succeeding. This is a fatal confusion. The headline investor's process of due diligence is not about understanding a company's durable competitive advantage or its long-term cash flow generation. It's about trying to guess what the next headline will be. It is a speculator's game, not an investor's. They are a passive consumer of information, a cork bobbing in the ocean of market sentiment, completely at the mercy of the tides of news and opinion. The result is almost always the same: a portfolio churned by constant trading, eroded by fees, and ultimately decimated by poor, emotionally driven decisions. They have abdicated their most important responsibility, the responsibility to think for themselves. The direct financial connection between primary source supremacy and your portfolio's performance is stark and quantifiable. Let's consider the American Express example. The headline investors of 1963, who sold in a panic, locked in a 50% loss. They sold a wonderful business at a moment of temporary, misunderstood crisis. Buffett, the primary source investor, bought their shares. His investment of roughly $13 million turned into a massive profit as the stock recovered and then went on to compound for decades. The difference in financial outcome was not luck, it was a direct result of their information source. One relied on the second-hand narrative of fear, the other on the primary source reality of a durable business. This principle manifests on a company's financial statements in what is often called economic goodwill or brand equity. American Express's true value, the trust it commanded from millions of cardholders, was not listed as an asset on its balance sheet. You could not find it by running a simple screen for low price-to-book stocks. It was an intangible asset, and its existence could only be verified through primary source research, both qualitative, talking to merchants, and quantitative, reading the long-term history of the business in its annual reports. Relying on second-hand information, which is almost always focused on the last quarter's earnings per share, causes you to completely miss the enormous value of these intangible assets. It's like analyzing a human being based only on their blood pressure reading from 5 minutes ago. You miss the whole picture, their intelligence, their character, their relationships. The financial advantage, therefore, is twofold. First, it allows you to be greedy when others are fearful. When a great company is hit by bad news, the narrative turns negative and the price drops. Because you have done the primary research, you can confidently assess if the problem is temporary and superficial or permanent and structural. If it's temporary, you are presented with a historic buying opportunity, funded by the panic selling of the headline investors. Second, it gives you the conviction to hold for the long term. True wealth is not built by trading. It is built by owning great businesses and letting them compound for years, even decades. This is only possible if your conviction is rooted in a deep, personal understanding of the business, an understanding that can only come from doing your own work. When the market inevitably crashes, the investor whose belief is borrowed from an analyst will panic. But the investor who has read 10 years of annual reports will see it as a chance to buy more of a business they know inside and out. That is the difference between mediocre returns and building life-changing, generational wealth. The annual report is the single most important document for any serious investor, yet for most people it's an object of dread. They see a glossy booklet filled with corporate jargon, intimidating charts, and endless tables of numbers. They might glance at the cover, maybe skim the highlights, and then toss it aside in favor of a tidy 2-page summary from their broker. This is a monumental mistake. The annual report is a company's yearly letter to its owners, and if you are a shareholder, that means you. To ignore it is an act of willful ignorance. Buffett approaches an annual report not as a chore, but as a detective story. Within its pages are clues to the company's character, its strategy, its strengths, and its weaknesses. The key is knowing how to read it not just for numbers, but for the narrative that lies beneath them. Let's journey back to the late 1980s. The market was recovering from the crash of 1987, and Buffett was on the hunt for one of his elephants, a massive, wonderful business he could buy a significant stake in and hold forever. He turned his attention to the Coca-Cola Company. Now, everyone knew Coca-Cola. It was one of the most famous brands on earth. But Buffett wasn't interested in what everyone knew. He wanted to understand the business on a level that nobody else did. So he started reading. He didn't just read the most recent annual report. He went to the archives. He read Coca-Cola's annual reports going back decades. He was looking for a pattern, for the DNA of the business. He saw a story of relentless, methodical global expansion, a company that was planting its flag in every corner of the world. But the quantitative story was only half of it. He paid special attention to the chairman's letter at the beginning of each report. He was reading for the voice, the philosophy of the people running the show. For years, the letters were fairly standard corporate fare, but then, in 1981, a new CEO named Roberto Goizueta took over, and the letters changed. Goizueta's letters were different. They were manifestos. He wasn't just reporting results. He was teaching his shareholders how he thought about the business. He wrote with incredible clarity about concepts like economic profit and return on equity. He laid out a clear, logical, and ambitious vision for the company. He wasn't just trying to sell more Coke. He was trying to create the most efficient and profitable enterprise possible. In one famous letter, he posed a question: what is the average daily fluid intake of a human being? 64 ounces. How much of that was Coca-Cola? Less than 2 ounces. Goizueta saw the other 62 ounces not as a limitation, but as an ocean of opportunity. Buffett saw this and recognized a kindred spirit. Here was a manager who thought like an owner, who was obsessed with the rational allocation of the shareholders' capital. While other investors were focused on the quarterly sales figures from North America, Buffett, through his deep reading of the annual reports, saw the bigger picture. He saw a business with a near unassailable brand, a moat around its economic castle. He saw a product with universal appeal and ridiculously low production costs. And now, he saw it was being led by a brilliant capital allocator with a global vision. He was reading a story of compounding magic that was just getting started. In 1988, Buffett began buying Coca-Cola stock. He invested over $1 billion, acquiring a stake of around 7% of the company. Wall Street was aghast. Analysts thought he was crazy. They saw an already massive company whose best growth days were behind it. Their models, focused on the next 12 months, couldn't comprehend the multi-decade vision Buffett had gleaned from reading the company's own history. They were looking at a snapshot. He had watched the entire movie. The rest is history. Coca-Cola, under Goizueta's leadership, went on an incredible run, and Buffett's billion-dollar investment grew to be worth more than 10 times that amount. His information edge didn't come from a secret phone call. It came from the patience to sit down and read the story the company had been telling about itself for 50 years, a story that was hidden in plain sight in its annual reports. The failure of Wall Street analysts to see what Buffett saw in Coca-Cola is a perfect illustration of a cognitive bias called salience bias. Our brains are wired to pay attention to things that are salient, that is, prominent, noticeable, or dramatic. In an annual report, the most salient number is usually the earnings per share, or EPS. It's the headline figure, the number that news outlets report, the number that determines whether a company beat or missed expectations. It's big, it's bold, and it's easy to understand. Consequently, the vast majority of investors and analysts fixate on it. They will spend hours building complex models to predict next quarter's EPS down to the penny. But this is like judging a great work of literature by the number of pages it has. The true story of a business is often found in the less salient parts of the annual report. The chairman's letter, like the ones Goizueta wrote, contains the company's philosophy. The footnotes to the financial statements, written in tiny print, contain crucial details about how the company accounts for its revenue or what its pension obligations are. The management's discussion and analysis section reveals how the leadership team thinks about its opportunities and challenges. These sections are dense, they are text-heavy, and they don't produce a single simple number. They are not salient. And so, they are ignored. Buffett's method is a conscious and deliberate effort to invert this bias. He forces himself to focus on the non-salient information. He knows that the company's long-term competitive position, the quality of its management, and its capital allocation strategy are infinitely more important than whether it earned $1.51 per share versus an expected $1.50. These crucial factors are qualitative, and their clues are buried in the prose of the report, not in the bolded numbers of the income statement. By training himself to read for narrative and philosophy, he can identify businesses with durable competitive advantages, the moats he famously talks about. A company with a powerful brand, a low-cost production process, or a network effect can endure for decades, compounding shareholder wealth along the way. A company that simply beats earnings for a quarter through accounting tricks or a temporary surge in demand might look good on the surface, but it lacks the foundation for long-term success. The average investor, driven by salience bias, chases the latter. Buffett, by systematically ignoring the salient noise and focusing on the boring but important narrative, buys the former. It's an information arbitrage opportunity created by a universal flaw in human cognition. To develop this skill, you need a structured approach, a mental model for dissecting an annual report. Let's call it the three-layer read-through. This isn't about reading the report 3 times in the same way. It's about reading it 3 times with 3 different objectives. Layer 1 is the skim for Gestalt. The first time you pick up an annual report, give yourself just 30 minutes. Your goal is not to understand every detail. It is to get the Gestalt, the overall feel and shape of the business. Start with the cover. What image did they choose? Is it a picture of a factory? A happy customer? An abstract design? This is the first clue about how the company sees itself. Then, read the chairman's letter. Read it quickly, like you'd read a magazine article. Is the CEO speaking in clear, plain English, or are they hiding behind corporate jargon? Do they admit mistakes? Do they lay out a clear strategy? Then, flip through the financial statements. Don't get bogged down in the numbers. Just look at the big trends. Is revenue growing? Are profits going up? Is debt increasing? The goal of this first pass is to answer one question. Do I find this business interesting and understandable enough to invest more time in it? If the answer is no, you've saved yourself hours of work. If it's yes, you proceed to the next layer. Layer 2 is the read from management's voice. Now you're going to go back and read the entire front half of the annual report, everything before the financial statements, with a highlighter. This time your objective is to understand the people running the company. As you read the chairman's letter and the business description, you are looking for clues about their character and competence. Highlight every specific goal they set in the past. Did they achieve it? Highlight every mention of their competition. Do they speak respectfully of them, or are they arrogant? Highlight how they talk about capital allocation. Are they focused on smart acquisitions and share buybacks, or are they obsessed with growth for growth's sake? By the end of this second pass, you should have a clear sense of the management's personality. Are these the kinds of people you would want to be in business with for the next 10 years? This is a critical question that most quantitative analysis completely ignores. Layer 3 is the forensic analysis. Now, and only now, do you turn your attention to the financial statements and, most importantly, the footnotes. This is the deep dive. Your goal here is to be a skeptic, a forensic accountant. Look for inconsistencies. If the CEO talked about expansion in their letter, does the cash flow statement show significant capital expenditures? If they boasted about profitability, how are they defining it? Read the footnotes on revenue recognition, on pension assumptions, on debt covenants. This is where companies often hide the unflattering details. This three-layer process transforms the act of reading an annual report from a passive chore into an active investigation. It forces you to go beyond the salient numbers and build a deep, qualitative understanding of the business and the people who run it, just as Buffett did with Coca-Cola. The antithesis of this deep, layered approach is the path of the 99%, which is walked by the quant jock. This investor is often intelligent and analytically minded, but they have fallen in love with the false precision of numbers. They believe that the secrets to investing can be found by running sophisticated quantitative screens on a database of thousands of stocks. Their process begins with a computer, not a business. They'll screen for companies with a price-to-earnings ratio below 15, a debt-to-equity ratio below 0.5, and revenue growth above 10%. The computer will spit out a list of 50 companies. The quant jock will then, perhaps, do a cursory glance at what these companies do, but their primary focus remains on the numbers. They might buy a basket of these statistically cheap stocks without ever reading a single annual report. The problem with this approach is that it is the epitome of looking at a snapshot instead of watching the movie. A low P/E ratio doesn't tell you times why times the stock is cheap. It could be a wonderful, temporarily misunderstood business like American Express in 1963. Or it could be a dying business in a structurally declining industry, a newspaper in the age of the internet, or a video rental store in the age of streaming. The numbers alone cannot distinguish between a statistical bargain and a value trap. The quant jock who buys a company based solely on its low price-to-book value might be horrified to learn, if they ever read the footnotes, that the book value is composed of obsolete inventory and outdated factories that are worth a fraction of their stated value. The investor who buys a company for its high revenue growth might miss the part of the chairman's letter where the CEO admits this growth is being fueled by a price war that is destroying the company's long-term profitability. The quant jock mistakes the map for the territory. They believe that financial metrics are a perfect representation of business reality. But they are not. They are a starting point, a clue. The real work is in connecting those numbers to the qualitative reality of the business, its competitive landscape, and its management. By skipping the deep reading of the annual report, the quant jock is essentially flying blind. They are owning a collection of tickers and statistics, not a portfolio of businesses they understand. This is why many of them underperform. They are playing a numbers game in a world that is driven by human behavior, competitive strategy, and long-term vision, things that can only be found in the text, not in the spreadsheet. The financial connection between deeply reading an annual report and building wealth is perhaps the most direct link in this entire process. It all comes down to the concept of capital allocation. The single most important job of a CEO is to decide what to do with the company's profits. Do they reinvest them back into the business to fuel growth? Do they acquire other companies? Do they pay down debt? Do they return the money to shareholders via dividends or share buybacks? The quality of these decisions over a long period is the primary driver of shareholder returns. And the best place to understand a CEO's capital allocation philosophy is in their annual letter to shareholders. When you read a letter from a brilliant capital allocator like Warren Buffett at Berkshire Hathaway or Roberto Goizueta at Coca-Cola, you see a clear, rational framework for how they will use your money. They explain their logic. They set benchmarks for returns on investment. This gives you, the shareholder, immense confidence that the profits the business generates will be used wisely to create even more value in the future. Conversely, when you read the letter of a poor capital allocator, you see a focus on vanity metrics like the size of the company or its appearance in the press. You see a history of overpaying for transformational acquisitions that destroy shareholder value. You see a tendency to invest in projects with poor returns simply to grow the empire. The numbers in the financial statements might look okay for a year or two, but a flawed capital allocation strategy is like a cancer that will slowly eat away at the company's intrinsic value. Let's quantify this. Imagine two companies, A and B. Both earn $100 million in profit. The CEO of Company A, a poor allocator, spends the $100 million on a flashy acquisition that only generates an additional $5 million in profit per year, a 5% return. The CEO of Company B, a great allocator, uses the $100 million to buy back the company's undervalued stock, increasing each remaining shareholder's ownership of the business by 10%. Over 10 years, the decisions of the CEO of Company B will create vastly more wealth for shareholders than the empire building of the CEO of Company A. The only way to tell the difference between these two CEOs before the results become obvious is by reading their own words in the annual report. Finding one great capital allocator and investing with them for a decade can have a more profound impact on your net worth than 100 brilliant short-term trades. This is the financial power of going beyond the numbers and reading the story. If the annual report is the glossy, marketing-approved story a company tells the world, the 10K is the legally mandated, unvarnished confession it makes to the government. And in that difference lies an enormous opportunity for the diligent investor. A 10K is a comprehensive report filed annually by a public company about its financial performance. It's regulated by the U.S. Securities and Exchange Commission, the SEC. While it contains much of the same information as the annual report, it is longer, more detailed, and crucially, written by lawyers for lawyers. There are no fancy pictures, no optimistic marketing language. It is dense, it is dry, and it is precisely for these reasons that it is so valuable. Buffett understood this better than anyone. His 2002 investment in PetroChina is a textbook case of finding extraordinary value by reading the document that nobody else would. At the time, PetroChina was one of the largest oil companies in the world, owned primarily by the Chinese government. The sentiment around Chinese stocks was poor, and the company was largely ignored by Wall Street. But Buffett, as is his habit, decided to do his own financial research. He didn't ask an analyst for an opinion. He asked for the company's 10K. He sat down in his office and started reading. He wasn't looking for a complex story or a brilliant new technology. He was looking for one thing: how much is this business worth? In the 10K, he found the simple, brute force facts. The document clearly stated the company's oil and gas reserves, its production rates, and its operating costs. More importantly, it laid out, as required by law, a valuation of the entire business based on its proven reserves and prevailing energy prices. The company's own legally vetted filing told him what it believed it was worth. Buffett then looked at the stock price, the total market capitalization. The price of all its shares combined was around $37 billion. But when he read the value the company itself implicitly placed on its business in the 10K, he saw a number closer to $100 billion. The market was selling this giant, productive asset for about 1/3 of its obvious stated value. There was no complex calculus here. It was simple arithmetic, available to anyone who took the time to read the filing. He didn't need to know about Chinese politics or forecast the price of oil. He just needed to believe the numbers that the company was legally required to report to the SEC. He invested nearly $500 million in PetroChina. Over the next 5 years, as the market woke up to the company's obvious value and the price of oil rose, the stock soared. Buffett sold his position for around $4 billion, pocketing a profit of $3.5 billion. When asked about this incredible investment, he didn't credit a secret source or a complex algorithm. He said, "I just read the annual report," referring to the 10K. It was a stark demonstration of his philosophy. The most valuable information is often not secret, just tedious. The entire thesis for a multi-billion-dollar profit was sitting in a public document, waiting for someone with the patience and diligence to read it. The reason the 10K is such fertile ground for finding this kind of mispricing is because reading it requires overcoming powerful psychological barriers. The first is the ostrich effect. This is our brain's tendency to avoid negative information. When we are excited about a potential investment, we naturally seek out information that confirms our bullish view. We want to read about the company's amazing new product, its visionary CEO, and its soaring growth prospects. The 10K, particularly the risk factors section, is a concentrated dose of negativity. In this section, the company's lawyers are forced to list everything that could possibly go wrong. They discuss intense competition, the risk of technological obsolescence, potential lawsuits, and regulatory threats. Reading this section is unpleasant. It directly challenges our desire to be optimistic about the investment. So, like an ostrich burying its head in the sand, most investors simply skip it. They engage in active avoidance of information that might spoil their rosy picture. The second bias at play is confirmation bias. This is our tendency to search for, interpret, and recall information in a way that confirms our pre-existing beliefs. If we've already decided we like a company, we will read its 10K not with a critical eye, but with the goal of finding evidence to support our initial conclusion. We will mentally downplay the risks listed and amplify the strengths discussed in the business overview. This turns the process of due diligence into a process of self-justification. Buffett's approach is the polar opposite. He reads the 10K with a mindset of active disbelief. He starts with the assumption that the investment is a bad idea, and his job is to see if the facts can convince him otherwise. He often says he reads the risk factors section first. He is trying to kill the idea. He knows that if he can't find a reason in the company's own legal disclosures to disqualify the investment, then it might actually be a robust and durable business. This is a profound mental shift. The average investor reads to confirm, Buffett reads to destroy. By actively seeking out disconfirming evidence, he vaccinates himself against the optimism and hype that so often lead to poor investment decisions. He understands that profits take care of themselves. The secret to long-term success is the relentless avoidance of catastrophic losses. And the best map of potential catastrophes is the one the company is legally required to draw for you in its 10K. To adopt this professional-grade skepticism, we need a mental model for dissecting the 10K. Let's call it the risk-first dissection. It's a 4-part process designed to force you to confront the negative information before you allow yourself to get excited about the positives. Step 1 is to invert and isolate the risks. Before you read anything else, go directly to the risk factors section. Don't just skim it. Copy and paste the entire section into a separate document. Now, read each risk one by one and rephrase it as a question. For example, if the company states, "We face intense competition from larger players," your question becomes, what is the specific evidence that this company can survive and thrive against its larger competitors? If it states, "Our business is dependent on a few key suppliers," your question is, what is the risk of those suppliers raising prices or going out of business, and does the company have a backup plan? This process transforms you from a passive reader into an active interrogator. Your goal is to generate a list of tough questions that the rest of your research must answer. Step 2 is to hunt for skeletons in the legal closet. After the risk factors, your next stop is the section on legal proceedings. Many investors skip this, assuming it's just boring boilerplate. This is a mistake. Are there any major lawsuits pending? Is the company being investigated by regulators? A single, significant lawsuit could potentially wipe out years of profit. You are looking for anything that represents a large, unquantified liability. Step 3 is to decode the MD&A. This is the management's discussion and analysis of financial condition and results of operations. This is where management is required to explain, in plain English, the numbers in the financial statements. This is where you connect the dots. If revenue went up, they have to tell you why. Was it because they raised prices, sold more units, or made an acquisition? If margins went down, they have to explain it. This section is the bridge between the numbers and the business reality. Look for changes in language from one year to the next. Is management suddenly using more cautious or ambiguous phrasing? This can be a red flag. Step 4 is the final verdict. Only after completing the first 3 steps are you allowed to read the more optimistic business overview section. By now, you are armed with a healthy dose of skepticism and a list of tough questions. As you read about the company's strategy and products, you can evaluate their claims against the risks and challenges you have already uncovered. This risk-first process acts as a powerful filter. For many potential investments, you'll discover a fatal flaw in the first or second step and be able to discard the idea immediately. This saves you an immense amount of time and protects you from falling in love with a story that can't withstand scrutiny. It forces you to do the work of an intelligent investor, to investigate, not to speculate. The antithesis of this rigorous, lawyerly approach is the path of the 99%, which belongs to the story stock chaser. This investor is captivated by grand visions and revolutionary narratives. They are drawn to companies that promise to change the world, disrupt entire industries, or pioneer new technologies. Their investment decisions are based on the power of the story, not the strength of the business. The story stock chaser will listen to a charismatic CEO give a presentation about the future of artificial intelligence or gene editing and become completely enthralled. They fall in love with the vision. They see a limitless future and a stock price that can only go up. They will then seek out information that confirms this beautiful story. They will read glowing media articles, follow enthusiastic social media accounts, and watch interviews with the CEO. They will actively avoid anything that might tarnish the narrative. The 10K is their enemy. It is a document devoid of romance and vision. It is a cold, hard recitation of facts and risks. To the story stock chaser, reading the risk factors section feels like an act of betrayal to the glorious future they have bought into. When the 10K warns that the company has a history of losses, no clear path to profitability, and is dependent on future funding rounds to survive, the story stock chaser dismisses it as just legal boilerplate that they have to put in there. They fail to understand that this is not boilerplate. It is a legally binding confession of the business's profound fragility. This investor is high on hope and dangerously low on skepticism. The catastrophic consequences are predictable. These story stocks, often with no profits and unproven business models, are incredibly volatile. When the narrative is positive, the stock can soar, reinforcing the investor's belief. But when sentiment shifts, when a competitor emerges, or when the company fails to meet its own ambitious timeline, the story shatters and the stock price collapses. The story stock chaser, whose conviction was based entirely on the story, is left with nothing. They have no anchor in financial reality, no understanding of the underlying value of the business, because they never bothered to read the one document that laid it all out for them. They didn't buy a business. They bought a lottery ticket with a great marketing campaign. The direct financial connection between a thorough 10K analysis and your portfolio is about the avoidance of what I call the zero. In investing, a 50% loss requires a 100% gain just to get back to even. A 90% loss requires a 900% gain. The math of large losses is brutal and unforgiving. The single most important thing you can do to ensure long-term wealth creation is to avoid the permanent loss of capital. The 10K is your single greatest tool for doing this. Let's take a concrete example from the MD&A section. A diligent investor is analyzing a retail company. In the MD&A, they notice a small sentence. Our inventory levels have increased by 30% year over year, while sales have only increased by 5%. To the casual reader, this is a boring data point. To the trained 10K analyst, this is a massive red flag. It suggests that the company is producing or buying goods that customers don't want. This bloated inventory will eventually have to be marked down and sold at a steep discount, which will crush the company's profit margins in the coming quarters. This single sentence, buried on page 47 of a 10K, can be the canary in the coal mine, predicting a future earnings disaster. The investor who catches this sells their shares or avoids the stock entirely, sidestepping the 40% price drop that occurs 3 months later when the company announces terrible earnings. That is a tangible, quantifiable financial advantage derived directly from diligent reading. Similarly, a detail in the legal proceedings section about a new patent lawsuit from a major competitor can alert you to a threat that could invalidate the company's core product. A change in the risk factors to include new language about cybersecurity threats could be a prelude to a major data breach. Each of these details represents a potential landmine that can blow a hole in a portfolio. The average investor, the story stock chaser, will walk right over them. The diligent 10K reader, the financial researcher, has the map that shows where they are buried. Over an investment lifetime, the simple act of avoiding a few of these catastrophic losses has a more powerful positive effect on your final net worth than picking a dozen winners. It is the defensive game that allows your offense to succeed. To build a truly durable information advantage, you must expand your reading beyond the documents a company produces about itself. A company does not exist in a vacuum. It is part of a complex ecosystem of competitors, suppliers, customers, and regulators. To understand the business, you must understand its world. This means venturing into the even more obscure and boring realms of information that Buffett devours: trade journals, industry publications, and the SEC filings of a company's competitors. This is how you build a complete, three-dimensional mosaic of the business, rather than the flat, self-reported picture you get from the annual report alone. The perfect illustration of this is Buffett's 1973 investment in the Washington Post Company. At the time, newspapers were a powerful business, but the market was deeply pessimistic about the Post. It had just gone public, was facing a costly labor strike, and the Watergate scandal, while a journalistic triumph, was a political and financial strain. The stock was cheap, but the narrative was negative. Buffett, however, saw something that Wall Street was missing. His insight didn't come just from reading the Post's annual report. It came from his deep study of the entire newspaper industry. He was a voracious reader of trade publications like Toint, Editor, and Publisher. He read the annual reports of dozens of other newspaper companies, from the New York Times to small-town papers. He was conducting a masterclass in industry-level, primary source research. From this wide-angle reading, he pieced together a crucial insight. A city's dominant newspaper was an unregulated local monopoly. In an era before the internet, if a local department store wanted to advertise a sale, they had no other effective option. This gave the dominant newspaper immense and durable pricing power. It was a fantastic business, an economic franchise with a deep moat. He then looked at the Washington Post specifically. It was the dominant paper in a wealthy, growing, and government-centric city. Its competitive position was unassailable. He also studied its other assets, which included Newsweek magazine and several television stations, and realized the market was valuing the entire company for less than the TV stations alone were worth. You were getting the world-famous Washington Post newspaper, this incredible economic franchise, for free. This comprehensive understanding, built by piecing together clues from across the entire industry, gave him the confidence to invest heavily. He bought a massive chunk of the company for about $10 million. That investment, held for decades, would compound into a fortune worth over $1 billion. It became one of his greatest triumphs. The crucial point is that this thesis, the local monopoly thesis, could not have been formed by reading the Washington Post's 10K in isolation. It required a broader information spectrum, a willingness to read the boring trade journals and competitor filings that allowed him to see the pattern that everyone else was missing. He didn't just understand the company. He understood the game it was playing better than anyone else. The reason so few investors undertake this kind of expansive, industry-level research comes down to a powerful cognitive shortcut known as the availability heuristic. This principle states that we tend to overestimate the importance of information that is easily available to us. Our brains are lazy. They prefer to make decisions based on what they can recall quickly and effortlessly. In the context of investment research, the most readily available information is the company's own stock price, recent news headlines about the company, and perhaps a few high-level analyst reports. Information about the competitive dynamics of the corrugated box industry, the latest pricing trends in railway freight, or the shifting regulatory landscape for regional banks is not readily available. It requires effort. You have to seek out obscure trade journals, dig through the filings of 5 different competitors, and read dense regulatory reports. Because this information is hard to access, our brains, guided by the availability heuristic, implicitly treat it as less important. We build our entire thesis about a company based on the 5% of information that is easy to find, and we ignore the 95% that is difficult but crucial. Buffett's method is a systematic rebellion against the availability heuristic. He deliberately seeks out the information that is not easily available. He understands that in a competitive market like stock investing, an edge cannot be found in commonly known facts. An edge can only be found in developing a superior understanding based on information that others are too lazy or too unimaginative to pursue. When he was analyzing the railroad industry before his massive investment in BNSF, he wasn't just reading BNSF's annual report. He was reading the reports of every major railroad. He was studying freight volumes, pricing per carload, and fuel costs across the entire sector. He was building a deep, fundamental understanding of the industry's economics. This allowed him to see that the entire industry had become more efficient and disciplined, transforming into a much better business than its historical reputation suggested. The information was all public. It was just scattered across thousands of pages of different SEC filings and industry reports. By doing the work to gather and synthesize this hard-to-access information, he was able to make a multi-billion-dollar bet with a level of conviction that an investor who had only read a single BNSF report could never hope to achieve. He had replaced the easily available and therefore useless market narrative with a difficult-to-acquire but incredibly valuable mosaic of facts. To systematically combat the availability heuristic and build this kind of deep industry knowledge, you can use a mental model called the industry mosaic method. It is a checklist-driven approach to ensure you are gathering information from a wide spectrum of sources, not just the single company you are analyzing. It consists of 5 key actions. First, the competitor cross-read. Identify the top 3 public competitors of the company you are analyzing. Download their latest 10K filings. You are not going to read them with the same forensic detail as your target company, but you are going to read 2 sections: the business overview and the risk factors. This will give you an invaluable perspective on how the competition sees the industry, what they are worried about, and what they see as their own advantages. Often, a competitor will highlight a risk that your target company downplays. This cross-reading gives you a more balanced and realistic view of the entire competitive landscape. Second, subscribe to the source. Find the 1 or 2 leading trade publications for the industry. These are magazines or websites written for people who work in that field every day. A subscription might cost $100 a year, but the return on investment can be astronomical. These journals discuss the mundane, operational details that never make it into the mainstream financial press. Things like pricing negotiations with suppliers, new manufacturing techniques, or subtle shifts in consumer preferences. This is the ground-level texture that brings a business to life. Third, the upstream/downstream check. Identify a key public supplier and a key public customer of your target company. Read their latest quarterly earnings call transcripts. What are they saying about their business? If a key supplier is complaining about weakening demand from its customers, that's a huge red flag for the company you are analyzing. If a major customer is boasting about how they are using their scale to demand lower prices from suppliers, that tells you something about your company's lack of pricing power. Fourth, the regulator's view. If the company is in a regulated industry like banking, insurance, or healthcare, you must seek out information from the regulators themselves. Government agencies often publish reports, statistics, and proposed rule changes that can have a massive impact on the industry's profitability. This is dry material, but it is essential for understanding the rules of the game. Fifth, the expert call. Find an expert in the industry, a former executive, a consultant, a journalist, and offer to pay them for an hour of their time. Platforms like Tegus or GLG connect investors with experts, but you can often achieve the same result with some diligent networking on LinkedIn. A one-hour conversation with someone who has lived and breathed the industry for 20 years can provide insights you could never glean from documents alone. By following this 5-part method, you build a rich, multifaceted mosaic of the industry. You move from a single point of view to a godlike view of the entire ecosystem. The antithesis of this expansive approach is the path of the 99%, which is the path of the company in a vacuum investor. This person might be quite diligent in their own way. They might do a very thorough job of reading their target company's 10K. They may have listened to every earnings call and built a detailed financial model. They can tell you everything about that one company. But their knowledge is a mile deep and an inch wide. They have studied one tree so intensely that they have no idea they are in a forest that is on fire. A perfect example would be an investor who, in the early 2000s, did a deep dive on Blockbuster Video. They might have correctly concluded that Blockbuster had a great brand, strong cash flow, and a dominant market position in the video rental industry. Based on the company's own filings, it looked like a solid investment. But the company in a vacuum investor failed to do the broader industry research. They didn't pay attention to a tiny, upstart competitor called Netflix, which was mailing DVDs and didn't seem like a major threat. They didn't study the broader technological trends of increasing broadband internet penetration and the nascent technology of streaming video. They didn't read trade journals about the plummeting costs of data storage and delivery. Because they only looked at Blockbuster itself, they completely missed the tectonic technological shift that was about to render the company's entire business model obsolete. They analyzed the present with great skill but had no perspective on the future because they were not looking outside the company's own walls. The result for such an investor is catastrophic. They can be 100% right about the company's current financial strength and still lose all of their money because an external force, a technological disruption, a new competitor, a regulatory change, completely rewrites the rules of the industry. The industry mosaic method protects you from this kind of catastrophic blind spot. It forces you to lift your head up and look at the horizon, to understand the broader context in which your company operates. It's the difference between navigating with a detailed map of a single street and navigating with a satellite image of the entire city. The direct financial connection of this expanded information spectrum is the ability to accurately assess a company's moat, or its durable competitive advantage. The strength and durability of a company's moat is the single most important determinant of its long-term value. A company with a wide moat can sustain high returns on capital for decades. A company with no moat will see its profits competed away. But here's the key: you cannot see the moat by looking only at the castle. You have to study the surrounding landscape. Let's quantify this. Imagine you're analyzing two companies. Both currently earn a 20% return on invested capital, which is excellent. Based on their own financial statements, they look identical. But your broader research reveals a crucial difference. Company A operates in an industry with low barriers to entry and dozens of aggressive competitors, a fact you learned by doing your competitor cross-read. Company B, you discover from reading trade journals, benefits from a unique patent and a powerful network effect that makes it very difficult for new entrants to challenge it. An investor who only looks at the companies in a vacuum might pay the same price for both stocks. But the investor who has done the industry research knows that Company A's 20% return is likely to be temporary. New competitors will flood in, a price war will erupt, and its returns will fall towards the cost of capital. Company B, protected by its moat, can likely sustain that 20% return for a very long time. The long-term compounding of value in Company B will be exponentially greater. This is the financial payoff of the industry mosaic method. It allows you to move beyond a static analysis of a company's current profitability and make a dynamic judgment about the sustainability of that profitability. It is the ability to make this judgment that separates the amateur from the professional investor and is the true source of a long-term information advantage. It allows you to pay a fair price for a wonderful business. confident that its moat will protect your investment for years to come. The final and most crucial step in this entire process is synthesis. It is not enough to simply gather information. An investor who reads 10 annual reports, 3 trade journals, and 5 competitor filings has accomplished nothing if they cannot connect the dots. They are just a data collector. The ultimate skill, the one that truly separates Buffett from the pack, is the ability to take all of these disparate, often contradictory pieces of information and weave them into a single, coherent, and powerful investment thesis. This is the moment where information transforms into insight. There is no better example of this act of synthesis than Buffett's acquisition of See's Candies in 1972 alongside his partner Charlie Munger. On the surface, See's was an unremarkable business. It was a family-owned chain of candy shops on the West Coast. Its financial statements were clean but not spectacular. It had modest assets, some stores, some kitchen equipment. Its growth prospects seemed limited. If you just ran the numbers, it looked like a decent but boring business being offered at a price that seemed a little too high. Many professional investors would have passed. But Buffett and Munger did the deep, multi-spectrum research we've been discussing. From the financial statements, the 10K equivalent for a private company, they saw something interesting. The business required almost no capital to operate. Customers paid in cash for the candy, and the company paid its suppliers later. It had a negative working capital cycle, meaning the business generated cash before it had to pay its expenses. This was a quantitatively beautiful feature. Then, they did the qualitative primary source research. They observed the stores, they talked to customers. They saw an almost fanatical brand loyalty. People didn't just buy See's candy. It was a part of their family traditions, their holiday celebrations. A box of See's was a gesture of love and nostalgia. This qualitative insight revealed a powerful, unquantifiable asset: pricing power. Because of the brand's emotional connection with its customers, See's could raise its prices by 10% every year, and no one would even consider switching to a cheaper competitor to save $1 on a Valentine's Day gift. This is where the synthesis happened. Buffett and Munger connected the dots between the numbers and the narrative. They realized that the modest assets on the balance sheet were not the true source of the company's earnings. The true asset was the brand, the loyalty that existed in the customer's mind. This economic goodwill, as they called it, produced all the profits but required no capital investment to maintain. Therefore, the company's real return on the capital it actually needed to employ was astronomically high. They saw a business that could grow its earnings year after year without ever needing to retain much capital. It was a cash-generating machine that would spit out its profits to its owners, who could then reinvest that cash elsewhere. They paid $25 million for See's Candies. It was more than its book value, a price that seemed high to a purely quantitative investor, but it was a steal for the economic reality they had synthesized. Since then, See's has generated over $2 billion in pre-tax profit for Berkshire Hathaway, all while requiring very little additional investment. It was a home run, not because of one piece of secret data, but because of the masterful synthesis of public financial data and qualitative real-world observation. The challenge of synthesis is immense because it fights against our brain's natural tendency towards information overload and analysis paralysis. The modern world bombards us with data. After conducting the kind of deep research we've outlined, reading 10 kilosecond, trade journals, competitor filings, an investor can find themselves with thousands of data points. Their brain, which is not designed to handle this volume of unstructured information, can easily become overwhelmed. This leads to one of two outcomes. The first is analysis paralysis. The investor is frozen, unable to make a decision. Every piece of positive information is mentally canceled out by a piece of negative information. They see the company's strong revenue growth, but also worry about the new competitor mentioned in the trade journal. They like the CEO's capital allocation plan but are concerned about a pending lawsuit. They get stuck in an endless loop of information gathering, always believing that one more piece of data will make the picture clear, when in reality, they are just adding more noise. The second outcome is a retreat to simplicity, but the wrong kind. Overwhelmed by the complexity, the investor discards all the nuanced qualitative information they've gathered and defaults back to a single, simple metric, like the P/E ratio. They do all the hard work of building a rich, textured mosaic, and then, at the moment of decision, they ignore it and just look at one tile. Buffett's genius is his ability to resist both of these traps. He has developed a mental process to cut through the noise and find the signal. He doesn't get paralyzed by the complexity because he is not trying to know everything. He is trying to identify the 2 or 3 variables that truly drive the business. For See's Candies, it wasn't the price of sugar or the cost of retail leases. It was brand loyalty and the resulting pricing power. Everything else was secondary. By focusing on the critical factors, he can filter out the overwhelming majority of information that is interesting but ultimately unimportant. This ruthless prioritization is the key to escaping analysis paralysis and achieving true synthesis. It is the art of seeing the simple, powerful truth that lies buried beneath a mountain of complex facts. To develop this crucial skill of synthesis, you need a forcing function, a mental model that compels you to distill your research into a coherent conclusion. This model is called the one-page thesis. After you have completed all your research, the annual report read-through, the risk-first 10K dissection, and the industry mosaic method, you must force yourself to summarize your entire investment case on a single sheet of paper. This is not a collection of bullet points or a data dump. It must be a short, narrative paragraph, written in simple, clear language, as if you were explaining the investment to a friend who is intelligent but not a financial expert. Your one-page thesis must answer 3 specific questions. Question 1. What is the simple, plain English story of this business? You must be able to explain how the company makes money in a sentence or 2. For example, for See's Candies, the story is, See's sells boxed chocolates at a premium price, primarily on the West Coast, to a base of intensely loyal customers who associate the brand with holidays and family traditions. If you cannot articulate the business story this simply, you don't understand it well enough. Question 2. What is the company's durable competitive advantage, or moat, and what is the evidence for it? This is the core of your thesis. You must name the moat. Is it a brand, a low-cost process, a network effect, a switching cost? And you must cite the specific evidence you gathered during your research. For See's, the advantage is the brand, and the evidence is the decades of repeat customer purchases and the company's demonstrated ability to raise prices consistently without losing business. Question 3. Why is this investment attractive right now? This connects your understanding of the business to the current market price. Is the market undervaluing the company because of a temporary, solvable problem like the salad oil scandal at American Express? Is it overlooking a hidden asset, like the economic goodwill it sees? Is it being overly pessimistic about an entire industry, like the newspapers in the 1970s? You must have a clear and logical explanation for why the market is mispricing this asset. The act of writing this one-page thesis is incredibly powerful. It forces you to move from passive data collection to active synthesis. It exposes the weaknesses in your argument and forces you to confront them. If you can't write it, your research is incomplete. If you can write it, you have achieved true clarity. This single page becomes your anchor. Months later, when the market is in turmoil and the news headlines are screaming, you can pull out this page and remind yourself of the clear, fundamental reasons you own this business. It is the ultimate antidote to emotional, fear-driven decision-making. The antithesis of this disciplined synthesis is the path of the 99%, the path of the data collector. This person is often very diligent and hardworking. They love the process of research. They will spend countless hours gathering information. Their computer is filled with beautifully organized folders. They have spreadsheets with financial data going back 20 years. They have downloaded every SEC filing, every investor presentation, every news article. They feel a sense of accomplishment from this activity. They have mistaken the gathering of information for the creation of knowledge. The problem is, the data collector never reaches a conclusion. They are stuck in a state of permanent due diligence. They have so many data points that they can argue any side of the investment case. They can tell you 5 reasons to buy the stock and 5 reasons to sell it. They mistake this ability to see all sides for sophisticated analysis, but in reality it is a sign of intellectual paralysis. They are a library of facts with no overarching story. When it comes time to make a decision, to actually risk capital by clicking the buy button, they freeze. The complexity they have uncovered becomes a cage. They lack the courage of their non-existent convictions, and so they do nothing. Or, if they do buy, their position is so small that it has no meaningful impact on their portfolio, because their conviction is weak and diluted. The data collector's fatal flaw is that they have no process for synthesis. They believe that if they just gather enough raw material, a beautiful sculpture will magically appear. But it never does. A pile of marble is not a statue. A folder of research is not an investment thesis. The final creative act of synthesis, of chipping away the non-essential to reveal the core truth, is what they are missing. Their journey is all prologue, with no final chapter. They do all the hard work but reap none of the rewards. The ultimate financial connection, the culmination of this entire 5-step process, is the ability to achieve true, long-term compounding. Compounding is the engine of wealth creation, but it is a shy and skittish creature. It only works its magic over long, uninterrupted periods. The biggest threat to compounding is not picking the wrong stock. It's being shaken out of the right stock at the wrong time. This is where a synthesized, one-page thesis becomes your most valuable financial asset. Let's imagine you did the work. You analyzed a wonderful business with a deep moat, you understood its industry, and you bought it at a fair price. You have your one-page thesis locked away. Then, a market crash happens. The economy enters a recession. The stock you own drops 40% along with everything else. The headlines are terrifying. The data collector, with their folder full of conflicting data points, will panic. The negative information will rush to the forefront of their mind, and they will sell, locking in a huge loss and interrupting the compounding process forever. But you, the synthesizer, will react differently. You will feel the fear, but you will not act on it. Instead, you will take out your one-page thesis. You will reread the simple story of the business. You will reread your evidence for its durable competitive advantage. You will ask yourself one question: has anything in this market crash permanently broken the long-term thesis on this page? In 99% of cases, the answer will be no. A recession doesn't destroy Coca-Cola's brand. A stock market panic doesn't eliminate the pricing power of See's candies. Your thesis, your anchor in the long-term reality of the business, allows you to weather the storm of short-term market emotion. More than that, it gives you the courage to act. You realize that the wonderful business you loved at a price of $100 a share is now being offered to you at $60 a share. You are being given the opportunity to buy more of a great company at a discount. You buy more while others are panic selling. This single act, the ability to hold and even add to your best ideas during periods of maximum pessimism, is what separates the builders of generational wealth from the average investor. It is a fortitude that cannot be faked. It must be earned. It is earned through the diligent, unglamorous work of primary source research, and it is forged in the final, clarifying fire of synthesis. That is the ultimate financial advantage. You have just invested a significant amount of your most valuable asset, your time, to acquire a powerful mental framework. You now understand that the greatest information advantage in the world of finance isn't about secret access. It's about the relentless diligence to read and understand the public information that everyone else ignores. You have the blueprint for how Warren Buffett and the greatest intelligent investors build their understanding from the ground up, starting with primary sources like annual reports and 10 kilosecond, expanding to the entire industry ecosystem, and finally, synthesizing it all into a coherent, actionable thesis. This is not just a collection of tips, it is a complete system for independent thought. But it's crucial to understand what you have just learned is a single powerful node in a much larger network of mental models that govern rational decision-making in business and investing. This ability to derive a unique information advantage is the foundation, but it is not the whole structure. It is like mastering the skill of reading a map. It is essential, but it is not the same as knowing how to choose a destination or how to manage your resources for the long journey ahead. The system you've just unlocked is connected to other equally powerful principles: how to think about valuation and price, how to assess management quality, how to construct a portfolio, and most importantly, how to manage your own psychology and temperament in the face of market madness. You have just mastered a critical piece of the puzzle. You have forged a key. But there are other doors to unlock. The video that is now on your screen is not just another video. It is the next piece of that map. It is the link that connects the information advantage you now possess to the next critical component in the arsenal of a true intelligent investor. It holds the key to another one of these interconnected mental models. Many people will stop here. They will feel satisfied with the knowledge they've gained and will drift away, leaving their mental toolkit incomplete. But for the few who are serious about this journey, for those who see this not as entertainment but as education, the next step is obvious. The choice is not whether to watch another video. The choice is whether you are a dabbler or a master in training. If you are ready to continue your ascent, to add the next layer to your mental armor and complete the system, then the path is clear. Continue your journey. Click and master the next piece of the puzzle.